Hi, Adam Gower here, founder of gowercrowd.com and host of the real estate reality show at youtube.com/gowercrowd, on good podcasts everywhere. And of course, you can find it at gowercrowd.com. Welcome to this week's edition of the real estate reality show weekly updates with my friend and guest, Dave Sachs, managing principal at Calvera Partners. This week, we're going to be looking at three top stories, as we do every week, that have been dominating the news in the last few days. And they are interest rate lag and the inevitability of more distress to come, and actually the debate around the impact of interest rate lag and whether or not there is distress going to come. Second topic is mortgage bank rate spreads and what's going on in the housing market. We'll hear some interesting comments from Mohammed El Arian on that topic. And then the last topic is I'm quoting from a headline here, the real estate hustle culture, which has also been part of the real estate crowdfunding story, crowdfunding in inverted commas, and whether or not it is actually going to take off for commercial real estate. What a question that is. So let me go to my notes over here. Hold on one sec. So, Dave, let's start with this topic. Globe Street had an article that headlined, maybe distress is behind maybe secret distress is behind CRE market performance. And what they say is, I'm going to read a quote here. There are signs of distress in CRE markets, jumps in distressed loan status, and banks increasing commercial real estate charge-offs. And yet the big wave of distress that everybody has been expecting that doesn't seem to be emerging. They go on to say that one fact many sources have been telling Globe Street is that any owner that wasn't under pressure for an immediate refinance, which is most of them, and this is the optimistic view, Dave, obviously, could likely afford to wait for property values to recover. That would mean, in effect, a large number of distressed properties for which there was financial pressure in the sense of falling value that could upset expectations, but not nearly enough to force a sale. Call that secret distress because it doesn't show up so clearly. And they go on to say, the same would be true if a commercial bank made a loan and is working with lenders to keep from having to write off value on their books. None of the banks is keen on raising questions as to the soundness of existing assets and potentially seducing depositors to race elsewhere. The last comment I'm going to read here from this Globe Street article is that they say many of the current opportunities come from distressed sellers willing to accept discounts on properties for which they're unable or unwilling to fund necessary capital expenditures. That would make sense and also suggests there is a significant amount of distress activity already happening. But conditions are far from different than during the GFC. And one expert told Globe Street that in the past, during the global financial crisis, back then, no one had faced such major calamity. Many panicked. Today, they know how to deal with it. Dave, do sponsors know how to deal with it? And if they do, which sponsors?
I think people are getting creative on how to deal with it. And there's a lot of different options that people can go through that we discussed, I believe, on last week's episode, with working with the lenders, buying back your notes, selling the property, maybe resizing your loan. But I think it's very market specific. As I've always mentioned, here in San Francisco, I would disagree with that article in that we're seeing a lot of distress. We're seeing a lot of distress. Office buildings going back to the lender in the news, massive portfolios of San Francisco apartments. I think we even saw the bankruptcy of a big hotel in San Jose a while ago. So the Bay Area is not avoiding it. In other markets, it's very possible that you could kind of kick the can down the road. But I'm a big believer that if interest rates stay elevated, I don't understand how you can't have distress, because there's no way that any piece of real estate is worth what you paid for it if you bought it when interest rates were really, really, really low. So I don't necessarily agree.
Well, that's the point, isn't it? Is this interest rate lag. And that brings us on to this article Bloomberg, on Bloomberg, landlords with $1.2 trillion of debt face rising default risks. Newmark sees defaults mounting for over-leveraged owners, and they talk about office accounting for the biggest share of troubled debt. But they go on to say that, here's a quote from that Bloomberg article, offices are the biggest near-term problem, accounting for more than half of the $626 billion of at-risk debt that's set to mature by the end of 2025. Office values have tumbled 31% from the peak in March 22, when the Fed started raising rates. But they share a chart here, and I will include a link to this article in the notes on YouTube and on the show notes at gowercrowd.com, that what we're seeing is a significant increase in apartment troubled loans. In fact, let me share that chart with you now on screen, Dave. All right, so here you can see the apartments. Why don't you comment on this chart? Of course, the black box here, 2024, is showing around 100 billion of apartment projected trouble loans coming due soon for apartments.
Right. I think the common narrative is, as you just mentioned, is that it's only office, and office clearly is the biggest problem child for obvious reasons. People not working in the office, downtowns, entering doom loops, etc. But people do forget that apartments also have expiring debt coming. As we've mentioned before, many owners or buyers of apartments got really aggressive by putting floating rate bridge loans on top of senior loans, and therefore they're massively over leveraged. I know this for a fact because we bid against folks who outbid us for apartments by 20+%. It's only a matter of time, and these are in very hot markets. So I don't care where you are in real estate, even the hot property type that we focus on, there's going to be problems.
Well, Bloomberg comments as follows on this topic. Concerns are mounting that defaults will increase as property values fall and costs rise for landlords who need to refinance at higher interest rates. Overleveraged owners are often more motivated to stop payments than sink money into buildings with diminished prospects for returns. Blackstone, Brookfield, and Goldman Sachs are amongst investors that have defaulted or relinquished offices this year. They are going to have every incentive to hand back the keys to lenders. David Bittner, global head of research at Newmark, said in an interview, "I'm shocked that it hasn't happened a lot more." Newmark defines potentially troubled as properties where debt represents at least 80% of the real estate's marked to market value, which nobody's doing at the moment, based on price indexes, including Green Street. Let me wrap up this quote from Bloomberg. After offices, apartment buildings are the next biggest category of potentially troubled properties, with $192 billion in debt needing to be refinanced through 2025. That is not a trivial number. Landlords who try to hang on and weather the storm are likely to take a bigger hit than those who cut their losses more quickly, according to Bittner. There's going to be a reckoning, he said, and everybody that waited to deal with the problem is going to regret that they did.
Yeah, that's a great quote. Well, when you see all of those very impressive large operators and owners of real estate who are the smartest guys out there ripping the Band-Aid off, they're doing exactly what you just said. It's coming. You can't avoid the problem. And then on top of that, it's not like it's getting any easier to, for example, run an apartment building. Insurance costs are off the charts. You've already got your interest payments going off the charts. In some markets, property taxes are way up. Even with distress, property taxes in Texas are way up because values have gone up from their bottom. So it's not like cash flow is getting any easier. And then when you add in all the extra supply coming online, which may soften rents, to your point, to the article's point, it's a coming.
And so the comment, I think the topic is this idea of lag, right? Interest rate lag. It's not a monolithic interest rate lag, right? It's not just, it doesn't apply to everything equally, or importantly, at the same pace. For example, there's lag on consumer debt, right? That will, once that kicks in properly, that will lead to a drop in spending. A lag on corporate and business debt that will lead to a reduction in business investments and a curtailment of hiring and possibly even job cutting. And of course, the lag on home mortgages and pricing and the freezing up of the home market nationwide, or the home sales market nationwide. And this is where most people have their wealth. And if that market dries up, which it has done, then you see money is not moving in the economy in the same way as it normally would.
Correct. I mean, particularly focusing on the mortgage side of things. Yeah, there's a freeze, and we might be getting into this, on the supply and demand sides. When you have really, really, really high interest rates for a new mortgage, you can't afford to buy a home. You don't have the money to cover the debt service and all of your other carrying costs. And then if you're fortunate enough to be in a home where your mortgage is 3% or locked in at something really attractive, including, my own. I mean, I have a low mortgage like everyone else. I refinanced at that time. If you sold, where are you going to go? Because you can't replace your home due to the expensive loans that you're going to have to take on. Math doesn't work.
Yeah, I think we're kind of migrating into the next topic, which was mortgage rate spreads. But let's kind of dial in on that slightly differently. Just stay on this topic of housing market. So here's an article from Business Insider. And this was their headline is, "The Fed may have destroyed the housing market by crushing both supply and demand," top economist Mohammed El-Arian says. It's very interesting, actually. I mean, his articulation of this problem is really easy to understand. Here's what he talks about here. He says, high rates have frozen. I got to clear my screen up a little bit here. Forgive me just for a second. High rates have frozen the housing market over the past year by crimping both supply and demand. Many prospective buyers are priced out of the market due to the higher costs of borrowing. Meanwhile, existing homeowners are discouraged from putting their properties up for sale, as many are looking to cling on to the low interest rates at which they financed their homes years ago. This has kept prices elevated as demand slips. The result is a housing market in a state of limbo, with affordability unlikely to improve unless mortgage rates dial back. Here's what he can. Let me just continue this here. There's some interesting insights from El-Arian here. When you go from record low mortgage rates to levels that we haven't seen for almost 20 years, you've destroyed both demand and supply. And that's the irony, is that supply has come down and demand has come down at the same time. That is the way you destroy the housing market, El-Arian says. We've got to be really careful because the housing market is central to the economy. And that's exactly the point, isn't it, Dave?
Absolutely. Many people, and those that are fortunate enough to own a home, that's a substantial part of their net worth. So if you're going to stagnate, or if that market is going to stagnate, that's not a good thing. And I have numerous friends that have talked to me about being in this exact situation here in the Bay Area. And it's a hot topic and not great for just markets in general.
Well, that's right. For the general economy, it's not good. And the general economy is really what drives the commercial real estate market as well.
Absolutely. Yeah, not a great thing.
So let's move on to our next topic. And that is the idea of the real estate hustle culture, and some articles that have, I'm not sure if it's quite the right term, but got my goat. I think that is a term. I'm not quite sure it is. Anyway, about real estate crowdfunding, because there's a lot of misunderstanding. But here's an article in that wonderful down the center of the political fairway, the New Republic, and they say the real estate. There's an article here. The real estate hustle culture. Oh, the real estate hustle culture con that is exploiting investors and wrecking the housing market. And they go on to comment about some litigation that has been filed against Grant Cardone. Everybody knows Grant Cardone. But I'll read just a little bit of this article. And I think that although they point directly to Cardone, this does apply. Sorry about that. This does apply to the general idea of marketing assets online, or at least raising equity for real estate online. So I'm going to replace, well, actually, I will read his name, but every time you hear me say Cardone over here, just think about real estate syndication. All right, so this is what they say. Cardone's actual rental housing strategy isn't particularly original or innovative in the realm of corporate landlordism. What makes his methodology different is the way he's been able to go directly to his audience to solicit investments, and in the process to cast hyper-aggressive renterism in the financial common sense. And that dovetails into an article that I saw, and this is the one that really got my shackles up in PropModo. Will crowdfunding, they ask, for commercial real estate ever catch on? And I will quote something from their article here. So it says, CrowdStreet is another firm that is eschewing its real estate crowdfunding platform for a new incarnation. That the thesis of this article is that that real estate, quote, crowdfunding is broken and that it's evolving into something completely different. But I'll get to that, to my point of view on this in a moment. In July, CrowdStreet, the real estate investing platform, announced that it would launch its new broker-dealer model as part of its year-long transition from online marketplace to financial institution. Okay, so that's fair enough. Fundrise and CrowdStreet are in evolution mode, but some crowdfunding companies, particularly such as Realty Shares, have disappeared altogether. Well, let's just talk about that for a second. So the idea that you can point to Realty Shares as some kind of indicator of the failure of, quote, crowdfunding is completely inaccurate. So Realty Shares went under in 2018, had nothing at all to do with real estate. It was because of the way that they were capitalized.
Absolutely. Yeah, we've talked about that before, and you're an expert on crowdfunding. But yeah, on Realty Shares, that was more how they were backed. Many of these companies, as we've discussed, are venture backed. So there's a lot of pressure on them to grow really, really, really quickly. It may impact the quality of the deals that are on there, or they just can't grow as quickly as their venture funding requires, and the funding dries out. It has nothing to do with the real estate market at all. So that's not to your point, that's not a great example.
So, so the point that I make is that what PropModo is talking about isn't crowdfunding. Crowdfunding is strictly and only under, technically, actually, only under regulation CF, regulation crowdfunding, which is heavily regulated and overseen by both FINRA and the SEC, and is actually a de minimis proportion of the real estate capitalization world. It's almost, I mean, it just barely, it doesn't move the needle at all. What PropModo and what a lot of misunderstanding about what's going on in, again, this idea of crowdfunding, real estate crowdfunding, is that it's actually syndication. This is something that has been done by companies and by real estate sponsors for over 150 years. And it has started after the Civil War. And the only difference today is that you can syndicate online. It has nothing at all to do with the fundamentals of what it is haven't changed. So sponsors will still syndicate at any time that you have anybody else's money in a deal other than your own. You are syndicating.
Right.
You're essentially
exactly right. Yeah, I mean, going back to my late grandfather, who I know was an investor in a shopping center in Silicon Valley, that was syndicated with a group of investors way before the internet. And that was real estate syndication. That's been around, as you said, forever. What's generally changed is the ability to advertise in various social media platforms. We all see that when we log into Facebook, LinkedIn, etc. Crowdfunding sites like CrowdStreet, Fundrise. It's really the technology That's
Exactly
changed,
right.
as well as the regulations, as you said, and the ability to advertise under heavily regulated rules you're supposed to follow.
Well, look, so and then the point I'm trying to make over here is that that what we're going to start seeing in the months to come is the true distinction of how the market has evolved and how it has become. But basically, that there are three different groups. There are sponsors soliciting for investors directly. That's syndicating, aka crowdfunding. Then there are platforms like CrowdStreet and Realty Mogul who are marketplaces for those same sponsors. That's something that is new. And then the third group that has emerged over the last 10 years since online syndication was permitted are what I like to call those who don't play by the rules. So the way to really understand this is that sponsors soliciting for investors and marketplaces are the equivalent of for sale by owner versus the multiple listing service, right? Basically, in the single family home market. Are you still there?
Yeah.
As I continue down this line of thought, and I've lost you on the screen because I'm reading from my notes here.
Okay. Yeah, I'm sorry.
The value add for investors that marketplaces ostensibly bring is that they add a layer of screening to the process of evaluating whether or not a sponsor is worthy of investment. And that equivalent is the same as either choosing to buy a stock directly by doing your own research online or buying a stock because your financial advisor suggested you buy it.
Yeah, absolutely. And we've talked before as well about how well they evaluate on some of these platforms and how much real estate knowledge that they have, because oftentimes they are tech companies first. You're also seeing kind of a combination of folks that do different things. So, there's groups out there that would have their own friends and family and syndicate it that way, and then also put that same deal on a marketplace. And then you're getting funds from two different sources. And then the last kind of point that I would make on this is, there's that third group that we all see on social media, where you're reading an ad and you're like, whoa, that's pretty aggressive. Watch out for those. And I'll just stop there.
Well, we'll take a look at, you know, that we're about to have a look at some of those just for good
Yeah.
But the real flushing out in this cycle is not going to be the crowdfunding platforms. They are going to have the legit ones. They're going to struggle because everybody struggles during a downturn. And it's not going to be the seasoned professional sponsors because they're also going to struggle, but they're going to come out of the other side. Anyway, they'll come out, they'll work their way through because they've been through it before. The ones who are really going to be flushed out are going to be the novice sponsors who have, and we get back to this article in New Republic, the novice sponsors who have leveraged crafty marketing tactics, right? I'll be straightforward about this. Created fake personas for themselves, pretending to be seasoned experts, professing extraordinary, track records, and essentially selling junk to investors. And the other group are going to be those people, and we have talked about this before, but those people who get paid for raising money for sponsors, a percentage of what they raise, no matter what tricks they employ to skirt SEC regulations that don't allow that. And then who inflate their own credentials by attaching assets under management numbers and experience and track records by association with the sponsors who they are supposedly representing. It's those folk who are going to be flushed out and cause most of the pain in this current cycle.
Yeah, this drives me nuts. I mean, as you and I both play by the rules and follow all the regulations very carefully, always consulting lawyers and accountants and all that stuff. And so it is somewhat infuriating when you hear these stories, see the ads of folks that are clearly not following the rules, which are pretty clear. And there's a lot of them out there. There just are. And it drives me absolutely nuts. I will say.
Well, it presents a real challenge to, again, we have discussed this, hard to stay off this topic, but because, and in the next few months, we are going to start seeing this more and more, but it presents a challenge to those folk who are playing by the rules, because it's very difficult to compete against them. You've alluded to this in terms of bidding on deals, that you're up against people who've got these wacky assumptions that just make no sense at all. In fact, let's move on to this. I'm going to call this our tongue-in-cheek section. I'm going to be very careful not to actually mention names, because I do know actually all of these folks. So I don't want to mention their names at all. But these are posts and ads that I've seen, or that we've seen over the last few days, live on the internet today. I saw one on LinkedIn where a sponsor, in inverted commas, who actually, well, I got to be careful what I say. But anyway, what they did was they were advertising or proudly announcing and I'm going to actually use a slightly different number as well, so you can't dial in on exactly what it was, but actually advertising that they hit an almost 100% IRR. So I thought, wow, gosh, and they're raising money now, right? So presumably, this is to shore up the case that they're making now. So I decided to have a look at it. 100% IRR. When did they sell? 2000. When was this? 2020. What? December 2021. They sold 2021 in 9 months. Don't tell me that cap rate compression and normal market conditions didn't turn that around.
Yeah, absolutely. As someone that was in the market looking to sell a property around that time, that was the time frame of, I believe, 3 caps, exit caps, 3.5 cap exits in certain markets. You can always financially engineer a return with luck, timing, but what really, really drives me nuts about that one, and I haven't exactly seen it, is when you put that in an ad, you're somewhat implying that you're going to do that again. And that is just so incredibly misleading. Markets are smart. Markets correct over a long period of time. I'm not gonna get a 90% IRR. I don't project anywhere close to that with realistic assumptions. Oh, it just drives me.
Well, that's exactly the point, isn't it? Past performance is no indication. You can play with numbers to make them look good, to seduce people into believing that you can do it again. Here's another one. This one I saw. I love this one. This is the what could go wrong. This is actually an ad. It was placed on Facebook. Here's how to raise millions, find deals, negotiate contracts, and manage properties, investing in apartments by using ChatGPT.
Oh my goodness. Is there more there? Or should I just
what could go wrong?
Well, sorry, I didn't mean to interrupt. That really got me. So I played around with ChatGPT, just for the record. Fun tool, great tool. But the first thing about ChatGPT, unless I guess you're on the most current version, is I believe their data or whatever they fed ChatGPT with ends in 2021, somewhere in 2021.
That's right.
So I used ChatGPT once to see if I could get it to write an article about distress and what caused distress. And the key point that it missed in its write-up was rising interest rates, because that didn't happen until after the data that was feeding ChatGPT to begin with. I have also tried to use it, and I've prompted it to tell me the top 5 markets for apartment investment going forward. And number one, I believe it responded to me saying, do not use this, or we cannot provide investment specific advice, but here are the 5 markets over the last whatever. So no, no.
I love the idea, though, that all you need is ChatGPT to raise millions, find deals, negotiate contracts, and manage properties for, how to make riches in apartments. It's just what could go wrong. And then here's another one. This is the last one. This is actually an ad for a new deal. It's actually, please send me money. And it talks about a multi-family deal Again, I'm not going to give too many details.
Yeah.
A multifamily deal, actually actively raising money now, with these bullet points for all the great reasons why you should be thinking about investing with this particular sponsor. One of them being rental growth rates of 2.4%. That makes sense.
Per year?
Per month. Per month. That's today. They're advertising that today.
Do they even say what market? Don't say
yes,
it. Yes,
but I'm not going to mention
I'm
it.
just curious. Oh, man. So, we come from an institutional background, as do you. The first thing you learn to put in your financial models is realistic assumptions that are based sometimes on historical and usually on historical trends. So you can back it up if asked by any sort of intelligent investor. So, what is the historical rent growth across the country? Some people 3.5%, 2.5%, depending. It varies by market. A huge red flag. You're seeing this per month. I mean, if you compound that, you're going way over the historical average in a time where all of the articles and what we're seeing is softening of rental markets due to a lot of supply and probably, I'm guessing, a market they're going to pitch here. So, right. Oh my goodness, it's just
so probably
it's against all of our training.
So I'm guessing maybe this sponsor is refining their underwriting using ChatGPT. Maybe that's how they got to that conclusion. 2.4% monthly growth rate. Unbelievable.
I never even heard of a projection quoted on a monthly basis. Just that alone, that alone I've never seen. And I've been in this business like you for a long time.
Extraordinary. All right. Well, Dave, thanks for joining me again. It's always a pleasure. And thank you, dear viewers and listeners, for joining Dave Sachs of Calvera Partners and me today. If you want to know more about real estate syndication and the reality of real estate investing, go to gowercrowd.com and sign up for our newsletter. It goes out every Wednesday and it's totally free. You can always unsubscribe and we cover all the latest news. Of course, go to YouTube as well, youtube.com/GowerCrowd, and make a comment. Do comment if you find these episodes of interest. And at GowerCrowd.com, you'll also find on the podcast page more information about Dave and about Calvera Partners, all there. Dave, thanks so very much. It's good to see you again this week. Have a good long weekend.
Hey, you too.